Karen, you still think the market is painting too rosy of a picture of what's going to happen with the economy and the Fed?
Yes, I think the market is really just starting to catch up. If you look at what you can see in the market pricing and you try to basically disaggregate what is the market really saying, if you split out in the bond markets, what are really inflation expectations relative to what are rate expectations and real yields? The market is still expecting that inflation comes down relatively quickly. This inflation problem is pretty short-lived, and that's true across countries, including Europe, the UK, the United States. And if you look at the stock market and basically try to disaggregate what's really happened to earnings expectations, how much do we expect earnings to be hit by all this relative to how much is the stock market just down because there are higher interest rates, so you want to discount earnings at a higher interest rate to today. Markets aren't really discounting a particularly bad earnings scenario. So that still adds up to a Fed that has to hike, central banks that have to hike, but that their hikes are enough to kind of magically both bring inflation down pretty quickly and get an earnings outcome where we don't really need a particularly serious recession to kind of get things back on track. And that's unlikely, not to mention that we don't have a huge risk premium priced in yet for what it's like to live through volatile inflation, stagflation, needing to ration. Those things are just starting to get priced in, which is why you're seeing such terrible market action.
So it's interesting that you don't buy the idea that inflation is going to come down very fast, even though part of the thinking there is that if we do get a recession and weakness in global economic demand, that will pressure inflation even further.
Right. Well, you need to either get a serious recession, which is not really priced into markets. And we know from the past that there is a lead lag. It's not like the economy slows and a minute later inflation comes down. We see in the past that it takes, 6 months, a year for it to make its way to inflation. First, you get deep economic pain before really inflation starts to slow. And that some of the, I think, overly optimistic views are that this energy stuff will kind of just go away, not realizing how much it has second and third order consequences. If you need to literally ration what you're making in the economy because you just don't have enough energy, that's an input into everything. And now you have a supply problem that's more pervasive and longer term, and you need to slow demand even further, get an even deeper recession before those price increases stop spreading across the economy.
So it's a pretty doomy, gloomy scenario that you paint of stagflation, which I know you've been warning about for a while. In the past, you have said that commodities are a good place to shelter. But if you're really worried about recession, is that still true?
I think commodities are not great in a true stagflationary environment for the reason you're saying, which is that when growth is weak, demand for commodities is going to slow at the same time. And you don't want to be idiosyncratically just in the commodities that end up being the most squeezed. I think stagflation is the toughest environment for investors for the reason you're saying, is that you don't want to be exposed not to strong growth and not to weak inflation, and most assets are. And it leaves investors with tougher choices. It leaves them with choices of looking for inflation protection wherever they can. And to me, one of the easiest things you can do is, change some of your nominal bonds to inflation-linked bonds. Instead of everyone has nominal bonds, everyone has a treasury. You might as well get paid whatever CPI ends up printing, because I think there's a decent chance it'll be higher than what is currently priced in. And in addition to that, look around the world. Not every country in the world has as gloomy of a stagflation outlook as the United States. Places like China and Japan look pretty different. And so just diversifying what you're holding geographically at least gives you some access to other places where stagflation is less on the agenda than certainly in Europe and the UK, and then in the US in a different way.